Hello again. Welcome to another episode of the Uranium Market Minute. Today is Thursday, January 20th, and this is episode number 66. My name is Justin Hune. I'm your host and the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you again for tuning in. As always, nothing in this video is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing. Always take responsibility for your own choices. All right, a bit to talk about today. A couple things happening in the uranium market. Looks like the market is trying to find some kind of consolidation bottom here after a pretty weak last couple of weeks, which was not quite expected and a bit of a surprise, at least in the severity and the depth of it and the speed of it. But it does look like we're trying to see some support here, so that's a good sign. And a couple of pieces of news I want to talk about in the mailbag section. But before that, let's jump right into the daily scoreboard. Spot price of uranium currently sitting at mid-market 44.87 a pound, down about 75 cents from yesterday. We're seeing a lot of trading action actually pick up in the spot market, and that's really interesting with SPUT out of the market. So what we're seeing is traders kind of take advantage of that quiet period from SPUT. It's possible that we're going to see increased trading action going forward in the spot market, SPUT or no SPUT, as a couple of things are on play here. What we're seeing is the likely inclusion of SPUT in URA. That rebalance is happening currently, which is one reason why the sector has been a little bit weak this week. Some of that selling coming from URA, selling down their underlying holdings, making room for SPUT. Also happening starting next month is the shareholder vote. That is February 22nd or 23rd, if I recall correctly, for Sprott to take over URNM. We presume that that will be approved and move forward with the Sprott Uranium Miners ETF. And obviously a little bit further out on the forward curve is the NYSE listing for SPUT. So there should be some frothy action in the spot market, probably throughout the year and leading up to especially the NYSE listing. So that's what we're seeing. We're seeing a lot of pounds being traded back and forth and the price ticking down a bit here, perhaps some motivated sellers. Either way, it's still $2.50 higher than it was a couple of weeks ago at the beginning of the year. Yesterday, SPUT raised a very small amount of money, $100,000, did not purchase any pounds. Their treasury now sits at 28.8 million in cash. They closed yesterday at a minus 0.23% discount to NAV. So likely that they're not purchasing or not issuing shares into the market today. Even though spot is down a bit, the trust looks like it's down a bit. We'll see when we take a look at the charts. Since the 17th of August, they've acquired 25.6 million pounds in uranium, raised over 1.1 billion. Turning to the equity ETFs in the uranium sector, both URA and URNM reported outstanding share increases of 100,000 shares. That led to a mandated buying of 8.7 million between the two ETFs. The combined AUMs moved up slightly yesterday, now sitting at 1.94 billion assets under management combined between URA and URNM. And I'm going to talk about that outstanding share count, which is now at an all-time high for both ETFs in the mailbag section. But before that, let's look at the charts. URA up a little over 1% on the day. It rallied decently earlier this morning, sold off a bit, but still in the green for the day. Volumes negligible, not a lot happening here, just continued kind of sideways chop. At least we're seeing some green on the screen, which is helpful. Spot Physical Uranium Trust down on the day, minus 0.69%, probably in line with the drop in the spot price, roughly trading right around NAV, most likely here. So volume, as you can see, really nothing to write home about. This again is likely a very strong pick for somebody looking for a risk reward here. The downside risk for the spot price of uranium in this trust is minimal in our estimation. I would say maybe 10 to 15% at the most, with the upside far higher. So on a risk reward basis, a very attractive position here. Either way, this trust continues to coil, and we do believe this will break out to the upside at some point. Cameco actually up a little over 1% on the day, but as you can see, intraday selling came in and knocked this one down a bit. still holding up well above its rising 200-day, actually one of the better looking charts in the space. So getting into the mailbag, I had a question come into me about the outstanding shares of the ETFs. So basically, not only do we monitor the spot physical uranium trust on a daily basis, but also the flows, inflows and outflows into URA and URNM. These are the two largest ETFs in the uranium space. There's another ETF, HURA, which trades on the TSX. That's a much smaller ETF, so it doesn't get as much coverage. URA and URNM are the two big boys. And so we monitor this every day because this really tells the story of what's going on in the sector and the flows. And when you dig into that, you can kind of get an explanation as to what's happening on the screen. So what's really interesting to note here, and I've noted this a couple times in the past, but I'll get into it a little bit more here, is that while we've been in a pretty fairly deep correction since mid-November, the sector as a whole has been in a 30 to 40% correction since mid-November, which is substantial. As I've mentioned many times before, this is not out of the ordinary for a resource bull market to see these types of corrections. But what is interesting is that type of correction, you'd expect these two ETFs would have experienced more share redemptions, which is a decrease in their outstanding shares and a selling down of their underlying holdings. We have not seen that. We've actually seen an increase in outstanding shares over the period of time from during this sell-off. So while the sector now, though it's rebounded a bit, so let's just say 35% drawdown from mid-November, we've actually seen the outstanding shares of the ETFs increase. So essentially, URA now has over 54.1 million shares, URNM 10.3 million shares. They're both now at record highs. So what does that mean to us? It means there has undoubtedly been sell pressure across the sector, but it's not coming from the ETFs. So if we were actually to chart the redemptions and issuance of shares for the ETFs on the up moves in the sector, the share issuance is substantial. And we see that flywheel effect. The ETFs do add to the buying. On the downside, we haven't seen it as much. There have been a few periods of share redemptions during the sell-offs that we've seen over the past 12 months, which have been multiple. We saw a big drawdown from June through August of last year. We saw another drawdown in September, and then the beginning of the drawdown in mid-November that's starting to try to find a bottom here. So what does that mean? If it's not the ETF selling, who is selling? Essentially, it's retail and perhaps smaller institutions actually selling the individual stocks rather than the money flowing out of the ETFs, causing the underlying holdings to be sold off. So what that means to me is that the institutional players, especially the larger ones that came in perhaps heavy December, January 2020, 2021, and again when spot really started to move, so August, September of last year, that those large institutional positionings are likely still positioned. That's my presumption in this situation, that they are now kind of stepping back, letting retail panic and sell down while the sentiment is in the toilet due to presumably the spot price kind of flatlining, due to the volumes flowing out of spot, due to a brief moment of expectations of a black swan with the Kazakhstan situation only to be deflated, 48 hours later. A lot of speculative money came in on that news and left pretty quickly. Now we're having the URA rebalance, which is creating some selling pressure. And a lot of retail sentiment is out there thinking, well, everything is lining up fundamentally. Why aren't my stocks moving? And this has happened. Okay, so I've been in the sector since 2017. I started researching in 2016, started positioning in 2017. And I can't tell you, it was years of this sentiment. It was years of, oh, the price will rise, huh? Oh, nuclear is being adopted here. China is expressing growth here. The price has to rise to get back to that cost of production, et cetera, et cetera, et cetera. All of these positive developments for years, 2017, 2018, 2019. And the stocks would kind of make mild movements up and down. This happens in the sector, okay? And you have to understand that the fundamentals for the sector can take a very long time for that to structurally move the actual physical commodity that makes up this market or that underpins this market. And so now we're in a situation where we have low sentiment, we have positive fundamental stacking, we have a unique catalyst that was unexpected even a year ago, that is about to come into play, which is Sprott taking over the largest physical fund, turning it into a trust, getting on an NYSE and having an ATM. So now leading up to that, in my opinion, what we're seeing is a base forming. We're seeing a base forming. We're seeing Sprott take over URNM. We're seeing the slow, relatively slow, but still substantial accumulation of physical pounds by non-industry players, so financials. And we're seeing the sentiment bottom out here. And so I think that the URA selling is probably going to pin a bottom for the sector. Does that mean that we're going to see a V-shaped recovery? No, I don't think so, actually. I think that we will continue to see a consolidation sideways for a bit. But I do think that we will see things start to run before that expected SPUT NYSE listing. With all of that said, a couple of other things that are interesting that are happening right now that have implications for the uranium market is, forever there's been this expectation that we would see the marginal cost of production would eventually have to be met. And that's still the case. However, those numbers that have been projected for years now, which is $50 to $60 a pound, I think you can throw that entirely out the window. We're seeing inflation across the world. We're seeing supply chain constraints. We're seeing labor shortages. All of these things have impacts on price. So when you say the marginal cost of production is 55 a pound, I think that's complete garbage. I think we're looking at more like $65 to $80 a pound and probably in the 70s. When we're talking about the projects that are on the margin, the higher cost projects. So 2 years ago, we would say that Bannerman's Etango project would need $70, $75 a pound. That's a big project. Will that be a buyout target? Possibly. Will that come online? Maybe down the road with higher prices, but you can even push that up higher, right? So all of these projects that are in care and maintenance. So you'd have Paladin's Langer Heinrich, you'd have Cameco's McArthur River, Rabbit Lake, a number of these projects, they're all going to need higher prices than we have been speculating on for the past few years. All of these developments in terms of vastly increasing rates of inflation and supply chain constraints, these are all post-COVID, post-government interjections with COVID as the reasoning for such interjections to cause these problems in the supply chains. I think to blame them on COVID as a cop-out, you can blame them on the governments and the government's the things that they have undertaken to supposedly protect the populace and stop the virus, et cetera. I'm not going to go too much further down that road, but clearly this is an engineered, whether it was intentional or not, crisis in terms of supply chains, labor shortages, et cetera, lockdowns. And so either way, it has happened and it continues to happen. And so we're seeing things like mining unions in Namibia on strike today. You see workers on strike at the Husab mine that is owned by the Chinese. This is a massive mine. They invested billions and billions of dollars in this large open pit mine. It's a pretty big producer, and we're seeing the workers on strike, demanding higher wages, seeing that the executives are giving themselves bonuses and the workers are not seeing their wages rise, at least not in line with the inflation that they're experiencing. So when we talk about $45 a pound uranium, I want you to just think about, especially if you're in a moment of stress about what you're seeing on the screen, is to think about, where's the price of uranium going to be a year from now? How about 2 years from now? What is the actual cost of production on the margin? And what is that going to look like to get to a quote unquote balanced market? If you think it's $55 a pound, you're completely nuts. We're talking about prices easily going to the 70s and 80s, and that's practically a guarantee. And the time frame is the one that's in question. But when you take such a substantial structural supply deficit that we're experiencing this year, and you add in financial demand that already is blowing everything out of the water as far as expectations, with SPUT purchasing over 25 million pounds since August, okay? Less than 6 months, 25 million pounds of uranium, okay? Then these entities are about to be listed on a market with 13x the liquidity of the market that they're currently trading on, run by the absolute powerhouse in the resource space, which is Sprott, with a massive clientele of huge institutions. I think that we know where this is going in the mid and long term. And so step back, think about these prices, think about what's happening in the world in terms of inflation and all of these other elements that are leading to higher prices of essentially everything. And you think uranium is going to be an exception to that? Absolutely not. So that's kind of what's on my mind today, just thinking about, whenever if I do get a period of frustration in the short term, which does happen, I try to be, I come off as cool as a cucumber, but red days do affect me too, as well as green days. Obviously, if it affects my just overall being and my emotional state. But just sit back, think, okay, Sprott's in control of the spot market. They really are. They're probably not going to be marketing like crazy until they have that NYSE listing. So between now and then, that's what we have to keep in mind. Okay, that's a short period of time away. We're looking at 6 months. That's nothing. This is going to be a 2 to 4 year trade minimum. Okay, so this is a period of time where, if you're positioning, great. You are still in an awesome position to add to your positions. If you've been in this market for a long time, then you should be up substantially. You should be not complaining about these dips. If you arrived at the highs in November, you're probably bummed that you're down 30%, 35%. But you know what? In the grand scheme of things, if you have the ability to add when the market is weak and you can see the bigger picture that's 1, 2, 3 years down the road, you can see what's coming. You can take confidence in those fundamentals. You can see the writing on the wall in terms of the energy trade, in terms of green energy, where nuclear is being adopted. Belgium is talking about reversing course. Where just 6 months ago, they reiterated they were going to seek a full closure of all of their nuclear plants. Now they're talking about reversing that course. We're seeing that across the globe, not in every jurisdiction, but more jurisdictions are embracing nuclear than are doubling down on turning the back on it. And that's by far. So that's the big picture. That's what I'm trying to keep in mind here. And that's the type of thing that we focus on at Uranium Insider, is taking all of these fundamental elements in play, distilling them down to what's actionable for you as an investor. If you are interested in our newsletter, click the link in the description. You will get a free sample of a previous month and get an idea about the type of content that we put out. We will have a monthly newsletter out for February in a couple of weeks. And again, we do these monthly webinars where we have a special guest from a company that we hold, and we go deep into the weeds of all of these fundamental developments for the sector to help give you confidence in this investment, because that's the confidence that we have, and we will continue to act on that confidence, whether or not the short-term trading action is positive or negative. The long-term outlook for the sector is unbelievably positive and bullish, and that's what we're here for. So thanks for listening, and thanks for being here. I will see you all tomorrow. Have a great rest of your day. Cheers.